Hello, everyone, and welcome to my short video on Chapter 3 of by the Digan book, which is about the theories of accounting. Now, if you are studying financial accounting, you might be thinking, hey, why I need to study theories? Okay, because I just want to learn how to do a balance sheet or how to make an income statement and so forth. The point that really needs to understand is that the financial reports are used throughout the society. They have a whole impact on the society and the people surrounding and your shareholders. They affect whether the organization will be supported or not. So, for example, this is a financial crisis going on during the COVID period, and the shareholders are expecting for the company to disclose more about the climate change and see how the company is contributing to the society. So, for them, the disclosures really matter. So this disclosure really affect whether the people wants to work for the organization or not. So they are not just some sort of a document that don't have effect on society. Financial reports kind of like create a whole impact throughout the society, and therefore we really need to understand what are those impacts. So you have some insights. So again, the position taken in this chapter number 3 throughout the book is that numbers can change behavior. That's very much important to understand. What I report will influence what people think about me. So there are social impact and so forth from the reporting, and there is also economic impact that what we report in our financial statements. So we need to understand that once we talk about different theories kind of like explain the behavior of the people react to the disclosures or the financial reports which you will prepare. So basically, it's very much important to understand the things that what motivates people to make certain disclosures and how will different types of shareholder react to the disclosure. There will be some sort of stuff that will cover under chapter number 3. Now, the first theory is about the positive accounting theory. These theories try to explain and predict. So these are the two main words that kind of like explain and they predict about the accounting practices. Now, theories can be broadly defined into a positive and normative theories. A positive theory is the theory which tries to predict or explain what's occurring. You know, whether it's the behavior of a counter or how the users might use information. Now, the positive accounting theory has been around there for quite many years. Like you can say it was very popular back in 1970s, but as the year increases back in 1980s, it's become more popular. And even the today literature still use this positive accounting theory. So positive accounting theory has two way of seeing the things. So they have two prospects. Number one is the efficient way. Another one is the opportunistic way. Now, as you will see that you will read this chapter and a positive accounting theory has these two branches. Under the efficient prospect, a positive accounting theory, there is a certain conflict that are discussed. So when an owner appoints a manager, there will be a certain possibility that the manager might not always work in the interest of the owner. And so there is an owner and manager contract. The positive accounting theory will suggest that we might use financial accounting to motivate our managers to work on behalf of the owner. So what they try to do, they start giving them different kind of bonuses, incentives. So they will feel that they are the part of this organization and they should work on behalf of this organization. And since their profit or their incentives are intact with the company bigger picture, bigger profit, so they kind of like feel they are the part of this organization and they will work hard for this one. Now the relationship between the manager and lender, for example, if a company borrow money from a lender, and there is already existing relationship between the manager and the lender, there might be a conflict of interest. For example, maybe the manager wants to use these funds in a way which a lender don't want. Means they take this money from the lenders and they invest that in climate change, or they invest that in the disclosure for the COVID, or society, or CSR. But the lenders don't want that. Lenders want us to increase their profit rather than investing or wasting money in the climate change. So there is a contract between a lender and the company. So in order to resolve this conflict, we use this accounting way, which is called debt contracts. So again, we might have a debt contract put into the place to try to get rid of that potential conflict of interest, which enables the organization to borrow the funds at a lower cost. So we use accounting in an efficient way where this accounting, so I'm borrowing a money from a lender, okay? They might assume that I will do it, I might do it in the, I might invest this money in a wrong place. So what we do, we use accounting number. We write a contract with them and use accounting number and try to reduce this conflict. So I might have a requirement where I sign a contract with the lenders, and that says that my debt to asset ratio should be positive, should be more than 1. So it means the assets I have should be equivalent to the money I own to the other people. I lend the money from the other people, from the borrower, from the existing borrower. And if I sign a contract that says that ensure that the debt does not get too high, the potential lender are likely to give me a loan at a lower interest rate. So in this way, two things happen. First, now the lenders has a more interest on me. And second, the conflict of interest is being resolved, and I'm, as a company, getting a lower interest rate. Another way of seeing the things according to the positive accounting theory is efficient prospects. What they try to do is to also to minimize the future urgency cost. So we see that the positive accounting theory starts to discuss how the accounting can be used efficiently to reduce the cost of the business, whether to motivate the managers, give them some bonuses, or to borrow money at a lower cost by using the accounting-based stats. Efficiency prospect, but there is an opportunistic prospect as well in the positive accounting theory. Every organization has many contracts. They are tied up to the accounting number. That's a fact. That's written already. Now, once they are in place and once you do all this contract, perhaps the managers try to manipulate the contract. For example, I do a contract with the same example that as a manager, I do a contract with my lenders that my assets will not be more than my loan, which I borrow from you. And it's kind of a helping both parties. But what managers do is kind of a manipulate or inflate the total assets. So when they inflate the total assets, it's still fulfilling the requirement of the numbers, but on the other hand, it's kind of violating the policy because the manager are working in their own interest. That is causing the conflict of interest. Because in this position, the managers are not acting on behalf of the lenders. They are just fulfilling the contract requirement between themselves and the lenders by keeping the ratio of asset to debt as much positive as they can. Now, accounting policy choice and creative accounting is another part of this chapter. If you have got a manager that paid a percentage of profit as bonus, that manager will have an incentive to try to inflate the profits and become opportunistic. If I'm the manager who borrow funds from the lender and I got the debt to the assets constraint, then I will try to increase the contract. We have the creative accounting. So the managers might try to manipulate the accounts that provides one explanation with the notion of creative accounting. So this chapter 3 will also talk about the creative accounting. That's pretty much about the positive accounting theory in a very quick nutshell. Stakeholder theories can be a positive or can be normative. Under the normative branch of stakeholder theory that argues that we should treat all the stakeholder equally. So there is no difference. Every shareholder who needs the information, every stakeholder who needs the information, we need to provide them the information, regardless whether they are big, small, or whatsoever. So there is also a positive branch of this stakeholder theory which is used by a lot of people basically in the research. Myself, I also use this positive branch of stakeholder theory in my PhD. So if I want to win a sport of a particular or potential powerful shareholder, I provide them with the information that might know. If you do not have that power under the managerial branch of the stakeholder, I'm not going to provide that information. So for this managerial branch, which is also called a positive one, the stakeholder needs to be a big one, needs to be a potential one. So for the other normative one, it doesn't matter how big or small the stakeholder is, we need to provide that information. But in the managerial one, our information is subject to how much significant that stakeholder is. Okay, so information is something we use strategically, and these theories talk about this. Another positive theory we discuss in this chapter is about legitimacy theory that discuss how the information can be used to win the support of the society and the community we live in. And particularly around the times when the things go wrong, like during the time of a COVID period, we require more climate change information. So we have to provide that more because it's our responsibility towards the society to provide this information. So for example, I had an environmental spillover. And as this chapter will show you, a lot of research has shown that the companies that do bad will often use their reports or disclosure as a whole of the positive information about the organization to try to win back the sport. So that's pretty much about legitimacy theory. Another theory is about institutional theory. This theory in this chapter that discuss about some sort of a disclosure I need to make within the particular environment, within first by the beliefs of the people within the organization environment. So what sort of a disclosure I might take in one country may not be applicable in another country. So my disclosures changes from one country to another country, and it won't be the same throughout the environmental setup. So, but there is some branches of it which believe that the disclosure should be same, our disclosure should be different, our disclosure should be according to the headquarter. So we will discuss that in our chapter. So then we can talk about some normative theories in the chapter. One obvious normative theory is the conceptual framework, which we discussed in the last video. Again, a normative theory prescribes how you should do something. It prescribes that's what the conceptual framework does. There are different theories which is in this chapter which discuss about the regulation. As you read through the book, you will see there's a lot of regulation and a lot of accounting standard. I got to know a lot of stuff, what the purpose of all this regulation. And so you might predict these theories of the regulation. Now, why do this accounting theory such as IASB board put into the place? One of those is a public interest theory. Well, perhaps because it is a public interest, so that's a theory of the regulation called public interest, which talks about the regulation which is introduced in the public. Then another theory suggests about the regulation that we will talk about in the capture theory. So what we're trying to do is we find out the regulator and we try to work with them in a mutual way to capture the mutual interest for the both of the parties. The third theory of the regulation is economic interest theory, which basically says that regulator, like everyone else, apparently are driven by the self-interest, and that whoever gets a regulation that best serves them, what the one who has the most voting power. So apparently, possibly not very healthy view of the humankind that everyone driven by the self-interest, and that another theory, that's another theory. And so we will finish here, and it's overview of the theories. In the end, I would say you have to read the book chapter very thoroughly, try to read them and see how interesting they are, how they are relevant to you, which of the theories you think is still applicable in the context of Malaysia, especially which of the theories are really forcing the current organization to have a disclosures. So especially right now, I'm discussing about different Malaysian contexts, which has to do the integrated reporting, where they integrate all the financial statements into one, and also the environmental disclosure in that, and Borsam Malaysia is working on this field of study. So it's very interesting that how the regulators are forcing the companies to put through the information which the company don't desire to disclose. Hope you have a good reading with this chapter. That is it for me. Have a good day. Bye-bye.